You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back. Hamish, what's going on, my friend?
What's going on? Not much. Got a haircut this week. I got my 6 monthly haircut, so I left.
Can you do a little turn? I didn't even notice. Can you do a little turn? Oh, very neat and tidy. Very neat and tidy.
Yeah, it looks pretty similar.
It's just all behind the ears.
Yeah, that's actually true. YouTube doesn't really see too much of it anyway because I always tuck it away. So it looks kind of similar, but yeah, I don't like.
It's quite interesting, because we don't really do any like vlogging or anything.
Yeah.
We're just kind of talking to camera. YouTube only ever sees us just straight front on.
Yeah.
So it's like the back of our head, like how we move, like all of that stuff that definitely makes up the appearance of a person.
Yeah.
People just have no... You'd hope that angle is good if you're a YouTuber. Like hopefully just looking dead on down the camera.
Well, and that's,
you look presentable.
Yeah, and that's the funny thing as well, because the different, depending on what lenses you're using and the focal length on the lens, you could look very differently on camera to what you do in real life.
That's a good point.
I'm sure some people have seen kind of those side by sides of different focal lengths and like how it captures kind of more of your face. So how like kind of thin or wide your face looks, it depends on the length of the what kind of lens you're using. So yeah, you could look so I actually haven't really thought about it. I think I look kind of similar to how what I look like on camera, but maybe it's completely different.
Yeah, no, definitely.
It is interesting.
When people recognize you in public, what do they say? Normally, like to me, when somebody recognizes me, they're like, "Oh, I thought you'd be shorter in person."
Yeah, they say, "Wow, the camera does add 10 pounds." No, they don't say that. Yeah, I always get the height one as well. I think for some reason people think maybe it's because when you watch YouTube, you're always like looking down into the screen. You just have this immediate like subconscious idea that the person is shorter than you. I don't know.
Yeah. How tall are you in centimeters?
183. I'm 6 foot.
183.
Yeah. What are you 6 foot 1 or 2 or something?
190. So I think that's 6.
Oh, 6'3".
2 or something? 6'3"? 6'3".
Yeah.
Right.
Yeah, something like that.
That is, I get that all the time though when you meet people and they're like, "Oh, you're a lot taller than what I thought you'd be."
Yeah,
anyway,
it's funny.
There we go. What are we talking about today, Hamish? We are talking about Alphabet's earnings. I'll run us through that. Google launching a ChatGPT competitor. RBA rate hike decision. We'll talk about that. Disney earnings. That will be interesting. I haven't followed because that just came out, didn't it? Like last night, didn't it?
It just came out about an hour ago from when we're recording this. So I literally just finished listening to the conference call. So yeah, a lot of interesting stuff to talk about with that one, I reckon.
Right. And then if we got time, we'll talk about this US jobs report stuff as well. So there is a lot to talk about. I'm interested to get into some of these earnings. So should we jump into it?
Yeah. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker through Sharesight, super easy, or you can do it one by one or downloading your trades using Excel. Whichever way you do it, it'll import all of your trades. And once you do that, it will track the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So to use that link, you can sign up to a free plan and track up to 10 holdings for as long as you want. Or you can also use that link to sign up to a premium plan for more features, and you'll get 4 months off an annual subscription if you do so. And as always, thanks to everyone who has used that link when they're signing up to Sharesight and is supporting the podcast.
Also, one thing I did want to mention this before we got started, is that, you know how last week we were talking about Meta, we were talking about severance and whatnot.
Yes.
Max actually sent us in a comment from the last episode, saying severance depends on how long you have worked at the company and what your salary was. It's not uncommon to get 3 or 4 weeks per year of service. So if you worked for 15 years, you might get 45 or 52 weeks of severance. And that's
Wow.
1 year's salary. So that I didn't know that that's how it works. So that makes a lot of sense as to why they let go. I don't know, however many employees, but it seemed
11,000
like
was
it was
recorded.
yeah. But it seemed like one year, and it was it was a couple $1 billion, I think, that it cost them. But when you break that down, that makes a lot more sense. Why the per employee statistic was so high. So thank you for letting us know about that, Max. Much appreciated.
Yep.
With that said, do you want to talk? We were talking Meta last week. Should we talk about Alphabet?
Yeah, take us
Talk about
through.
Google.
Yeah, take us through Alphabet. How are they doing? Because Meta last week, for context, there wasn't much growth on their business. They had the kind of the FX impacts, and they're still kind of dealing with this shift towards Reels, away from feed and stories. So that's kind of hurting their cost per advertisement. And then they've of course got their metaverse investment. So let's put that in context with how Google is doing, at least on the advertising front comparatively.
Yes. So Google reported Q4 and full year results. So we'll just go through Q4 at the start. So their revenue was $76 billion, which was only up 1% year over year, although up 7% on a constant currency basis. So you can see there's that impact again of the strong US dollar.
Yeah.
For those, I will go through down through their revenue segments. For those that don't know how they break it down, so they've got Google Search and Other. They've got then YouTube ads. Then they've got their Google Network. They've got Google Other, and then Google Cloud and Other Bets. So for those that don't know, Google Search and Other is like Google Ads and other Google-owned and operated properties like Gmail, Google Maps, and Google Play. So advertising related to those things. Google Other revenues consists of things like Google Play, or obviously YouTube ads. It's just YouTube ads. Google Network is all the third parties that use Google ads on their websites. And then Google Other consists of Google Play, which includes sales of apps and in-app purchases. It includes hardware, which includes Fitbit, Google Nest Home products, Pixel devices. It includes, interestingly, I actually didn't know this, it includes YouTube non-advertising. So in subscription revenues from services such as YouTube Premium and YouTube TV, and then also other products and services. And then Google Cloud is obviously all of their cloud-related stuff. So that's a quick explainer. And we'll get into the stats now. So Google Search and Other, so all of that Google advertising goodness. Search reduced by 1.6% in the fourth quarter, which is quite interesting, the revenue from search. So it went down to $42.6 billion. That's by far the biggest chunk of their revenue.
Yeah.
Then YouTube ads reduced 7.8% year over year. Google Network reduced 8.9% year over year. So overall, Google advertising as a whole reduced by 3.6%. And then beyond that, we also have that Google Other segment, which had growth of 7%. Cloud grew 32% in the revenue department, and Other Bets grew 25%. Interesting, they also note that TS, what does TAC stand for? Traffic acquisition cost. Is that right?
Yeah.
That's correct. Which are payments that internet search companies make, like Google, they make to their affiliates and online companies for directing traffic to their websites. That was $12.925 billion, down from $13.427 billion. And interestingly, they noted their total number of employees is up to 190,000 from 156,000. So, geez, that's a lot of employees, isn't it?
Yeah. Oh my God, that's crazy. Interesting to see. Yeah. So Google is also facing some of the difficulty that Meta's had just in the overall advertising industry. Struggling throughout, especially towards the later end of 2022, on the back of a tough economic macro environment that has gotten a lot worse than what we've seen in a long time, and businesses look to cut advertising first. So it makes perfect sense to, before even we might see other businesses start to cut other kinds of costs and that sort of thing, it makes sense that we're seeing the first bit of pain in advertising.
Yep. Advertising, bang, didn't do so well. Search down, YouTube ads down, Google Network down, and then you have the growth in Google Other, so all those other hardware sales. So non-advertising stuff, it grew. Cloud, non-advertising, that also grew. So yeah, you're exactly right. It's just the advertising business that went down a little bit. In terms of operating income, they came in with 18.2 billion versus 21.9 billion in Q4 of last year. The operating margin fell from 29% to 24% year over year. So then next up, if we look at the segment operating results, so we're not just looking at revenue, but we're looking at actually their operating results, so factoring in all their expenses. So Google Services, which is Google Ads and Google Other, that dropped by 23%. Then we had Google Cloud, which actually managed to halve its loss from $890 million down to just a $480 million loss. Still a lot of money to lose, but still, it's getting there. And then Other Bets increased their losses by 12%. So you can tell once you just look at when you actually look at operating results as opposed to just revenue, you can definitely tell what's critical to Google's business, which is their advertising business. But interesting that dropped 23%.
Yeah, it'll be interesting. I'm very curious to watch Google Cloud. I've looked into this a little bit. I certainly find it an area that I'm not quite sure what that business looks like over time, but Google Cloud is a lot smaller than its kind of two biggest competitors, which are Amazon Web Services and Microsoft and their cloud business. But on a profitability basis, Google is also a lot worse than both of those businesses. So it's very likely that to catch up to those businesses, they're kind of investing ahead in terms of the infrastructure and the staffing needed, and a lot of the additional employees that they've gained. What did they gain? 40,000 employees or something recently over the past year. A lot of that is going into cloud. So it'll be interesting to see, how quickly they can get that to profitability, and if those margins do get as good as like Amazon, for example, is I think 3 times the size and has like a 30% margin or something like that, which is really good. And yeah, Google Cloud is obviously not even profitable yet, so that'll be interesting to watch.
It's interesting. They've got a ways to go, it seems.
Yeah, for sure.
Yeah. Okay, so that was their fourth quarter results. So, slow down, definitely slow down.
Yeah.
Their full year results, I'll just quickly go through a couple of key stats. Their revenue came in at $282.8 billion, which is up 10% year over year, or up 14% on a constant currency basis. So again, being hit with that foreign exchange impact. Operating income was $74.8 billion for 2022 versus $78.7 billion in 2021. So they actually came in with less operating income, and their operating margin fell from 31% to 26%. Now I looked through their maybe I was having a dumb moment, but I looked through their actual 10K. And you know how they give their impressions and paid clicks? They only had the 2022 whole numbers, the whole full year numbers. So we'll just, I guess, go off that.
Yeah.
So they had impressions for 2022 versus 2021 were up 3%. So
you're modest.
Not huge growth, if I'm honest. Cost per impression was only up 1%. Right. So cost per impression really not moving. Then they had paid clicks. How many paid clicks? That was up 10%. They know that was from an increase in search queries resulting from growth in user adoption and usage, primarily on mobile devices. It was also from growth in advertiser spending. I'm putting a big question mark next to that because I just don't believe them. I don't understand. And also improvements we've made in ad formats and delivery. That makes sense. The cost per click, so paid clicks up 10%. The cost per click was down 1%. They say that was a result of changes in device mix, geographic mix, advertiser spending, there you go, ongoing product changes, and property mix, as well as the unfavorable effect of foreign currency exchange rates.
Yeah.
So,
this is the problem, I think. It would be so good. I think you're right. I think they don't have a quarterly figure for the paid clicks and the cost per click, but we kind of need that because a lot of the slowdown has been just in this last fourth quarter. I mean, I think you said said their full year revenue was still up 10% or 14% constant currency. It's really just the last quarter. Same with Facebook in the last couple of quarters, but it's really the last couple of quarters where that has shifted. So yeah, that being able to say growth in advertiser spend, I'd love to see if that was still a factor in the last couple of quarters, which I would guess it probably wasn't. Overall throughout the year, probably yes, but throughout the quarter, yeah, I'm not too sure about that. But yeah, interesting to see, you know, their numbers relative to Facebook, which is seeing a much bigger increase in ad impressions, but actually a decline in the cost per impression. Facebook's going through this, or Meta, I should say, it's going through this big shift in the types of ads that they're providing and how many they can show, whereas Google is a little bit more of a steady ship where they're kind of just growing very slowly, the number of impressions, but there's also not much change going on in how much advertisers are paying for those ads. So interesting to see that dynamic.
I feel like they're also more diversified in their ad formats and delivery versus company like Meta, which is just pure social media. I guess it's interesting. What else do they say in their report? They said, in January 2023, we announced a reduction of our workforce of approximately 12,000 roles. We expect to incur employee severance and related charges of 1.9 billion to 2.3 billion, the majority of which will be recognized in the first quarter of 2023. So similar story.
That's insane.
That's story.
Actually interesting because they laid off 12,000 and had 1.9 billion, and Meta laid off 11,000, so about the same, but had $1 billion. It was just under $1 billion. So it's actually interesting. Google's severance is costing a lot more than Meta's. But yeah, both of them are astounding. $1 billion, $2 billion in severance in a quarter is wow. That's crazy.
Yeah, it is flipping bonkers. What else do they say? As AI is critical to delivering our mission of bringing our breakthrough innovations to the real world, beginning in January 2023, we'll update our segment reporting relating to certain of Alphabet. What is that sentence? We'll update our segment reporting relating to Alphabet's AI activities. DeepMind, previously reported within other bets, will now be reported as part of Alphabet's corporate costs, reflecting its increasing collaboration with Google Services, Google Cloud, and other bets. Sundar, that was just from the report. Sundar said, quote, very soon people will be able to interact directly with our newest, most powerful language models as a companion to search in experimental and innovative ways. And I think you've got something to talk about with this, don't you?
So Alphabet reported last week. So that's what they said last week. And then this week, they announced this companion to search, which is really just a kind of a reaction. Of course, it's something they've probably had in the works for a while, but it is becoming public now as a reaction to ChatGPT, OpenAI's ChatGPT, which is kind of taking the world by storm. It's kind of the thing that everybody is obsessing over, especially over the last couple of months. So, is that all you had for Google's earnings? Should I jump into talking about this?
Yeah. The only other thing I was going to say is that the stock dropped 4% after hours. And one interesting tidbit from the conference call: YouTube Shorts now has 50 billion daily views. 50
billion daily views. Wow. That's crazy. That's insane.
That is pretty flippin' bonkers. Anyway.
Yeah. So what did their stock fall? Their stock fell 4%. They had another stock fall last night in relation to a very embarrassing mistake they made with the announcement of this AI chatbot.
Oh, really?
So I'll talk about that. But first, I'll give a bit of context. So they announced a chatbot called Bard. Which is an interesting name. It's probably a better name than ChatGPT, but it's still not great. Couldn't they have come up with a better name than Bard?
I don't know. Yeah, it's just like it makes me think of like Skyrim or something.
Yeah, just
the bards and stuff like that.
Yeah,
anyway,
I don't know.
Yeah, it's a bit strange. I don't really know what the vibe is there, but sure, Bard.
We'll go with it.
Welcome, Bard.
Google Bard.
We'll go with it. And you're right, it is a better name than ChatGPT.
Yeah.
Remember when that came out? Like, what the ChatGPT? What GBD?
Yeah. Terrible name.
GDP.
Pretty much. We didn't get too much information on Google's new service, but they demonstrated it in a blog post and they gave some examples of it being used. And it looks like in the future they're planning on implementing this into Google search, essentially at the top before normal search results. So you know how at the moment sometimes you ask a question and it does actually give you a bit of a blurb from maybe their best site, but it usually is just literally word for word a paragraph from maybe the top search result. Whereas now that section will essentially be the AI giving you a description like ChatGPT does, which would ultimately be better than just grabbing a paragraph, which often just has the keywords in it and doesn't actually tell you the answer that you're looking for. You usually have to click into the website to do that. So that seems like a pretty natural way for it to be implemented. It's of course not going to replace doing your own searching online, but it can kind of complement your searching and help you get to certain answers faster. And it looks very similar to ChatGPT, although it's not open to the public, so no one can like do a side-by-side test to test information or answers. But over time, it will very likely become public, so we'll be able to do those comparisons. It was really funny. So they ran an advertisement a couple of days ago, or actually, sorry, it was yesterday. They ran an advertisement and about this new AI chatbot, and in the ad they showed the bot getting an answer wrong, which I thought was pretty funny. They asked the question about the James Space Telescope, and they got something wrong about which telescope was the first to take a photo of the solar system or something like that. Which is very funny. And the stock, as I was alluding to earlier, the stock fell 8% after this advertisement ran, erasing $100 billion off the market cap of Google. So
come on.
Whoever did that mistake, I'm sure is getting a nice severance package.
But you'd feel bad. Was this like a live thing?
No. So it was just an ad, and it was basically just showing classic Google ad where it's just someone types out an ad, a question, and then it gives an answer. And it just so happened that part of the answer was wrong, and no one really checked it. No one fact checked it.
So there's no proof checking. Yeah, there's no proofreading of the ad, and they just aired it, and then sorry.
Yeah.
Yep.
Yeah, so an embarrassing mistake. I mean, yeah, it's obviously I think
100 billion.
We all know that these chatbots they're interesting, but they're not perfect, and that they're obviously making both ChatGPT and this Google one will make a lot of mistakes. So it's not like
It's very interesting, I find, because they're language models, because their language and their phrasing and their sentences are very, very good. When you read it, it just makes you believe it.
Yeah, it's more convincing.
Like, it's very convincing. Like, you just read it and you're like, oh, okay, I didn't know. That's so interesting. Because it uses big words and it says the numbers so confidently. It's not just like, it'll never tell you, look, don't hold me to that, but it just says what it thinks. And it's crazy because that's like you can apply those same principles with people. It's usually people can say things incorrectly, but if they say them very confidently, then other people tend to just believe them.
Yeah.
Because they sound so confident, so sure.
Yeah.
But that is very interesting. That is very interesting.
Yeah. And this comes kind of at the same time as Microsoft also this week announced that they're planning to implement ChatGPT's capabilities into Bing search. So you mentioned a couple of weeks ago, Microsoft added to their investment in OpenAI. I think they added $10 billion investment, and part of that is, of course, they're going to be using the features of ChatGPT in Bing. So I really hope Bing doesn't work, just for the fact that I don't want people to be like, oh, I'll just Bing it. I like saying I'll just Google it. I don't want to live in a world where Bing is like a word that I hear a lot. Bing is a bad word. That's not a great word. That's you know what I mean? Like it's just go Bing that. No, that's terrible.
Yeah.
Don't please. Or change the name. Maybe they can change the name to something else.
Maybe
I don't like it.
I'd probably do that. It's probably worth it because it's just a laugh. It's like laughable.
It's an embarrassing like platform at the moment.
You'd want to like take it down, repackage it with this new ChatGPT stuff, and then release it as something new.
Yes,
that's how I would do it.
Yeah,
not try and save Bing's reputation, which is already in the mud.
Yeah, it's horrific. So, but that'll be interesting. So, we're finally getting a little bit of innovation in chat, in search, which we haven't had for a very long time. With Google just kind of making little minor tweaks here and there because it's been so good. But this is kind of a leap forward in this technology for the first time in a long time.
Yeah, I think it's awesome. I think it's going to be really cool. Next few years will be really cool seeing it be integrated properly into search.
Yeah, for sure.
Looking forward to it. All right, dude. You want to talk about, so that was Alphabet and all that's going on there, and also a bit of ChatGPT stuff. Let's talk about Disney.
Yeah, let's do Disney. This
Can we please?
This came out this morning. It came out, and I was listening to the conference call, which had some Bob Iger was back on the conference call. Of course, he's back at the helm. So it was interesting to hear some of his further explanations of some of the things that he's been talking about recently, in the changes he's going to make to Disney to get it back on track. But before that, revenue came in for the quarter at $23.5 billion, which was up 8% year over year. So continuing to grow their massive media and parks empire. Of course, we can talk about kind of two key segments which they have. One is media, entertainment, distribution, and the other is parks, experiences, and products. So we'll start with the media and entertainment, which represents the majority of their business. Revenue for media and entertainment came in at $14.8 billion, up 1% year over year. So pretty flat for their media business. It was, if we look at the different segments, there was quite a different story in different segments. So you had the linear networks revenue down 5%. And then you had direct to consumer, or their streaming, up 13%. And then you had content and licensing, which was flat. So those are the three main bits that go into their business. Content was flat, linear continued to decline, and streaming continued to grow, which is kind of what you would expect, given that
is what you would expect.
People are canceling their cable subscriptions, so they had lower affiliate fees and lower advertising revenue, and direct to consumer continued to grow. In terms of direct-to-consumer specifically, revenue came in at $5.3 billion, which was up 13% year over year, as I just mentioned. In terms of their different streaming platforms, which is I'm sure what everyone is interested to hear about, Disney Plus subscribers reached 161.8 million, which was down 1.4 million subs over the quarter. ESPN Plus reached 24.9 million subs, up 0.6 million subscribers quarter over quarter. Hulu, and this is a combination of live TV and just normal Hulu subscriptions, came in at 48 million, which was up 0.8 million subscribers quarter over quarter. Essentially what happened was they really had flat growth or pretty modest growth with their subscribers in the US and some of their main markets. In their Hotstar, Disney Plus kind of Indian customer base, which has been this huge subscriber base for them, but paying very little. They did a massive price increase, and they lost a few subscribers there. So that kind of represents kind of what's happened. But on balance, throughout the entire year, the streaming platform, and during the quarter, the streaming platform continued to grow revenue. So they essentially were able to squeak out a little bit more revenue from increasing their prices on their Hotstar customers. But yeah, certainly their subscriber growth was very muted in the last quarter.
Definitely.
I think they had. Sorry, what were you going to say?
I was just going to say it's very interesting too, comparing. Well, they're kind of in a similar boat now to Netflix, where subscriber growth is kind of. I don't know if it'll change for Disney, depending on what they do in the future. But we know that Netflix is kind of like neither here nor there with subscriber growth at the moment.
Yep.
But I was just looking before. Netflix total subscribers as of the fourth quarter of 2022 was 231 million. So there's still quite a gap, 231 million versus Disney Plus 161.8 million.
Yeah, and I mean, even subscribers doesn't even tell the whole story either. I mean, as I said, Disney's most...
Yeah, we always talk about this, don't we?
Like most of Disney's subscribers is people paying, I think, less than $1 per month in India. So yeah, the subscriber number is catching up to Netflix, but in terms of total revenue, they're still quite a way off. But yeah, I mean, I thought that this would happen to a lot of these streaming companies because, and I think Netflix kind of just felt it a little bit earlier, which is that it's a tough macro environment. You've got increasing costs of everything, and subscribing to multiple streaming services is just not a necessity. So it makes sense that people might look to that to cut. And it's. I'm a little bit surprised that Disney Plus is struggling to grow even in the US. I don't think they added any subscribers in the US, and they only have about half as many subscribers as Netflix in the US. So that was surprising to me. But the overall slowdown to me doesn't really reflect that Disney is doing particularly poorly. I think it more reflects the challenging macro environment.
The macro.
Yeah.
Yeah. No, I tend to agree.
The D2C their D2C segment lost $1.1 billion in the quarter, and they said that they're going to try and be profitable by financial year 2024, which is the next financial year because they run one ahead. If they meet their targets. So they sandbagged the hell out of that by saying that they have to meet subscriber targets, their content goals, and all of this stuff. But that's what they're kind of aiming for in terms of getting there.
If we hit every single one of our goals, then we will be profitable.
Yeah, I mean, it was kind of...
our goals are to double our amount of subscribers and triple the revenue raised per user, but, you know...
Yeah, it was hilarious. On the way she just said it on the conference call was so funny. She was like, yeah, we're going to be profitable by 2024, but remember that this hinges on us hitting subscriber goals, our content hitting our goals, on macro environment and inflationary pressures. Like, she listed like 10 things, and it just sounded like she was not, like, they're not confident at all that they're going to actually be able to hit that. But anyway, that's their goal going forward. And I'll talk a little bit more about media with the conference call stuff, but just quickly, the parks, experiences, and products segment continued to do really well for them. $8.7 billion in revenue, which was up 21% year over year from higher volume and higher and increased guest spending. So that continued to be a beast for their business, especially while the media segment is kind of going through this transition. It's interesting. They announced a new segment going forward, revenue segment, which is going to be to separate ESPN into its own operating segment alongside the other two existing segments. And I was thinking exactly what someone asked on the conference call, which is, are you preparing this maybe to spin it off or to sell this sports part of their business and just focus on more drama focused and kids content, rather than kind of this sports segment, which has been increasingly getting expensive? Iger said no, but of course that's what he would say. So before there's a deal on the table or anything, I would not be surprised if that's the route that he's going. Because otherwise I'm not exactly sure what the rationale is for segmenting out sports into this kind of separate thing.
Doesn't make sense. So hang on. So that'll be a new revenue segment.
Yes.
Is that right?
So they're completely
it'll be
separating
media and entertainment distribution.
Yep.
It'll be parks, experiences, and products. And then it'll be ESPN. Yeah, I feel like that's just odd.
Yeah, somehow I'm not buying
this
this story.
odd because it slots in. It's media and entertainment distribution. That it's in there. It's clearly
and
why would you take it out of there?
His argument was that it doesn't. It's like it is different from kind of the film and TV that they produce, which it is, but. Does it deserve its own revenue category where all you're operating?
You've only got two.
Yeah, like why would you go to the effort of separating the financials of this business if there wasn't some other particular reason? But we'll see. Maybe over the next couple of years we'll kind of see if that happens. But given Iger's recent commentary on reshaping the business, it wouldn't be surprising if they did some spin-offs and some selling parts of their business. Just quickly on the conference call, there was a bunch of interesting stuff. He spoke about taking Disney back to a return to a focus on creativity. So he wants to give creatives in the business more control over the distribution and sales decisions to kind of reconnect the creative work with the financial performance. So that'll be interesting to see how that works in terms of changing how they distribute content going forward. They said they're going to cut back on general content and focus more on curated, higher return on investment franchised content. So things like Marvel and Star Wars, big budget stuff that has higher returns for them. They also noted that by focusing more on curated content, they'll actually have more capability to produce content for third parties, which is exactly what Warner Brothers said just a couple of weeks ago about doing more licensing and content sale to other distributors like Netflix, for example, as kind of an avenue of producing revenue. They actually said they might bring the dividend back at the end of the year, which is funny because it was only a couple of weeks ago that who was it that activist investing firm was having a go at them for cutting the for cutting the dividend. The name is I'm blanking on the name of that firm, but that was really interesting to see them say we're going to bring the dividend back. I don't know if they're in the position to do that either. It's kind of it's kind of a difficult spot.
Oh, look, it's probably just the old grandmas that just want their dividends. Oh, I've always got my dividend from Disney and now it's gone. Bring it back, please.
Yeah.
You know, I don't know.
Yeah, it's tough.
So it's such a dangerous game. I don't know. Dividends. Like, yes, we get the rationale of when you should pay a dividend versus when you shouldn't. You know, if you can, if you've got better uses for that money by reinvesting it back into your own business, then don't pay a dividend. Just don't.
Yeah.
And then if you, on the flip side, if you're a super mature company and you don't have any good uses for it, then sure, give it to me and as a shareholder, and I'll go put it somewhere else where it can grow into more money. But you're right, it's just the psychology. Dividends are so psychological. Like once people start getting them, they get used to getting them. And then if they don't get them, then it can cause just Armageddon. People being like, all right, I guess Disney's not paying me my retirement dividends anymore. Yeah. Guess I'm out. ExxonMobil or Chevron, here we come. I don't know.
Yeah, it is interesting. So we'll see if they pay that. I think it's pretty unlikely they'll be in a position to pay a dividend, but they're claiming that they will be. So we'll see. At least for me, it was the funniest part of the conference call was to give context. Up until this point in the conference call, the stock in after hours was up 8%, and then Iger got a question about the future of media and streaming, and he essentially said streaming is the future, which is what he said all along, but that it's not producing the same profitability as linear, which is kind of this declining business. So he's essentially kind of admitting that they're losing this linear business over time, and it's not being replaced at the same rate as streaming. They're actually coming out of this less profitable. It was just funny. As soon as he said that, the after hours stock price just plummeted right off a cliff. No. But essentially, he gave a little bit of context into how they're going to handle this. He thinks that linear and theaters will continue to produce some monetization for a long time. And a big part of this is that a lot of the older audiences, so the 60 plus, are still very much using linear and also going to theaters. So that audience hasn't moved over to streaming yet. So they can still access that audience and still monetize it. So essentially they're saying they're not going to abandon kind of these old methods, but it's going to be kind of a part of this blend strategy going forward with linear, with doing more third-party licensing to other platforms, and then their streaming services. So a lot of interesting discussion. There was way more that I didn't mention. So if you're curious about this kind of stuff, then I recommend checking out the conference call. Because
nice,
very interesting.
Very good. All right. Shall we keep things rolling?
Yeah.
And I'll just quickly talk about this US jobs report and this Jerome Powell interview. It's not that interesting. Well, some of it's interesting, actually. I shouldn't downplay it that much. The jobs report was interesting. So this will give us context before we talk about the interview. So the jobs report for January was released over in the States, and it definitely surprised people. The labour market is just very, very strong at the moment. So non-farm payrolls increased by 517,000 for the month, shattering analysts' estimate of 187,000. Yeah, 500. What?
That's crazy.
517,000 new jobs. And to put that into context, in 2022 there was an average monthly gain of 401,000. Wow. So it's smashing that average. But yeah, it certainly caught analysts by surprise. So the unemployment rate fell to 3.4%, which is the lowest since May 1969. So unemployment in the US is very, very low. They had also, neither here nor there, hourly wage growth of 0.3%. Although this news technically can be taken poorly, it's great for, people, but it can be taken poorly as well because it gives the Federal Reserve a little bit more freedom to hike interest rates without worrying too much about it.
Yeah.
Powell said it himself, he didn't think that it would be that strong. So we may as well move on to what he did say in this interview. It was an interview at the Economic Club of Washington, D.C. Gosh, doesn't that sound like an exclusive elitist club? The Economic Club of Washington, D.C.
Oh, boy.
Oh, what's that? You have a net worth of less than $10 billion. You can't come in, I'm sorry.
Whenever I hear something like that and you give quotes on this stuff, I'm always just imagining like a bunch of dudes just like sitting in a cigar lounge like oh, yes. So jobs came in a little bit higher than normal.
Yeah, I imagine a very, diverse group of people. I think you'd probably get every single different type of 60-year-old white male in that room. It'd be remarkable.
Oh boy.
Anyway, what did he say? Quote, the disinflationary process, the process of getting inflation down has begun and it's begun in the goods sector, which is about a quarter of the economy, the central bank chief said during the event. But it has a long way to go. These are the very early stages. Then asked whether it would have influenced the Fed's rate call if the jobs report came out before the policy meeting. Powell said, we don't get to play it that way, unfortunately. He said, if the data shows that inflation is running hotter than the Fed expects, it will mean higher rates. Quote, the reality is we're going to react to the data, Powell said. Quote, so if we continue to get, for example, strong labour market reports or higher inflation reports, it may well be the case that we have to do more, that we have to do more and raise rates than what is already priced in.
Yep.
That sentence doesn't make sense to me.
Yeah.
He has to increase interest rates. Sorry, I was just trying to read that.
Yeah,
I think maybe there's some typo or grammatical error in there.
Yeah, I mean, I think we've spoken about this a couple of times, but yeah, a month ago, the expectation in the market was really it was 25 basis point rate hikes for this year, which is nothing. And we've already had one. We just had one last week. We spoke about it. And yeah, with inflation still hot, with the labor market really hot, then I think it wouldn't be surprising at all if they did quite a few more rate hikes above what is already baked into the market. So yeah, I think it's going to be another interesting year where the market thinks, oh, everything's all good and just runs off. And then maybe it's not quite good yet, so the market comes back down. Because remember, you've got this whole stock market, especially of institutional investors, who are just trying to catch the bottom of this and the start of a bull market. That's why we've had this run up in the last month so quickly, because everyone's thinking, okay, this is the bottom. Let's get in. And if we get some negative news, it'll go back down again, and we'll just have this kind of volatile up and down market until there really is a sustained trend in one direction or the other. So, that's just kind of what's playing out, both in the US market and in the Australian market with interest rates and inflation.
Yep. Jerome said, we expect 2023 to be a year of significant declines in inflation. It's actually our job to make sure that's the case. I'm glad he realizes that. Good one, Mr. Powell. My guess is it will take certainly into not just this year, but next year to get inflation down to closer to 2%. Our message at the last meeting was this process is likely to take quite a bit of time and it's not going to be smooth. It's probably going to be bumpy, and we think that we're going to need to do further rate increases, as we said, and we think that we will need to hold policy at a restrictive level for some period of time. Yeah. So, yeah. I mean, it's a story, it's a non-story, because he's basically saying if inflation is high, then we're going to raise rates. If inflation goes very low, then that's great.
Yeah.
Whoa. Mind blown.
Great insight, Jerome. Great insight. No, but
yeah, he was.
sorry.
Yeah, sorry.
No. All I was going to say, it is kind of crazy that the rates have gone up so quickly and there hasn't really been a reaction, at least so far in the market. I mean, we saw Facebook and Google's earnings and businesses are pulling back their advertising spend, but we haven't seen, that, at least I haven't seen it shift into other businesses yet in terms of their revenue. They're trying to save. They're trying to cut costs because inflation is hurting their profits. But in terms of their revenue and demand for their products and services, I haven't really seen it come off yet. So, but that's really surprising given how much
we've seen like plateauing.
Yes,
but we haven't.
Yeah,
seen that.
Maybe it's
any
maybe it's going to be a soft landing. It's going to be no recession.
Maybe, Hamish.
This will be the one time.
But no, that's a good point. We haven't really heard any like, revenue was down 10%. Or something like that. Or revenue was down 15.
I looked at sorry, cut you off. I looked at Chipotle. I think it was yesterday. Restaurant company. I think their revenue was still up at 8% or something like that. So that's where I would expect to start to see it. Okay, people are not going out as much anymore. Okay, people are not buying cars as much anymore. Like I would expect to see it in some of those areas. And here and there I've seen it, but not in a broad way, which is really surprising. At least so far.
Do you want to keep rolling on into this RBA rate decision stuff?
Yeah. So we got
sure.
back over in Australia. We of course had the Reserve Bank of Australia give its decision on interest rates, and this comes after, of course, another record inflation figure in Australia. So everyone kind of knew what was coming, which was in the end a 25 basis point increase in the official cash rate, which is our official interest rate here in Australia, to bring it to 3.35%, the highest level in just over a decade. So we've been doing rate hikes pretty consistently, but at a much slower rate than the US, so our rate's a lot lower. To give some context as to how this will affect mortgages as these rates are passed on by the big banks, a $500,000 loan will see a $76 per month increase, and in total, since the start of these rate hikes, a $500,000 loan has had an increase of $908 per month added to the mortgages. For $1 million mortgage, the increase this month is $152 per month, and in total, it's $1,816 since last year, which is crazy how a relatively small number of rate hikes can have such a dramatic impact, especially in something like housing. Philip Lowe said in his press conference, the governor of the RBA, he said, the board's priority is to return inflation to target. High inflation makes life difficult for people and damages the functioning of the economy. And if high inflation were to become entrenched in people's expectations, it would be costlier to reduce later. The board is seeking to return inflation to 2 to 3% while keeping the economy on an even keel, but the path to achieving a soft landing remains a narrow one. So essentially there's a...
Thanks, Jerome. Philip.
Yeah, it sounds exactly the same. Well, that's actually funny because, Powell in his meeting just a week ago said the same thing. They don't want inflation expectations to get entrenched. So essentially, if they don't do enough now, people will start to expect high inflation and they'll start purchasing more now, which is just a vicious flywheel of people spending more now, more inflation, therefore people have to spend more money now, and it just goes on and on and on. So they're trying to prevent that by getting on top of it now. And it was interesting to say that they think a soft landing is unlikely. And a bit of evidence to support that was I found in an article from, I can't actually remember where it was from, but I read an article and it said that 800,000 mortgages will be switching from a low fixed rate to a 6% or higher variable rate this year. So there's a lot of mortgages coming off this year. We've been talking about this for about a year now. These 2-year, 3-year rates that were set in 2020 and 2021. There's a lot, and that's going to cause a big drop. And it's going to be kind of like a cliff in a way for people's household income because it's not progressive. It's all of a sudden, there's going to be a big increase for a lot of people. And that will very likely, we would expect to see that ripple out into a lot less spending in other areas, so less business revenues, layoffs, and so on and so forth. So balancing that with inflation is why that's the narrow kind of path that the RBA is walking on now. in that it's very difficult to balance those things, especially when there's such a delayed effect between the rate hikes and the effect in the economy. As we said, Australians are on these 2-year fixed rates, so there's a bit of a delay with how this comes through. But once it does, we'll kind of see, how everything kind of plays out. But unfortunately, our inflation rate just isn't going down, so the rates just have to keep going up.
That is such a crazy stat, though. That is such a crazy stat. 800,000. There's only, 26 million people in Australia total.
I was going to say, just for context.
And
we're a small country, so that's a lot if you're outside.
We are a small country in terms of population.
Yeah.
800,000 mortgage holders will be switching from a low fixed rate to a 6% or higher variable rate in 2023. Wow.
Yeah.
Wow.
And
watch the housing market, everybody. Let's go.
Yeah. And for, to give maybe a bit more context on that, the average 2-year fixed rate in 2021, so the ones that will be rolling over, was about 2.2%. Or 2.2 to 2.7%. So if people were on those rates, they're going from 2.2 to 2.7% to 6% or more if they go into a variable rate, or higher if they go into another fixed rate. So it is a big increase, and we'll see how it plays out. But unfortunately, there's not really much the Fed can do. They're kind of at the not the Fed, the RBA, because they're kind of just at the mercy of the inflation that is the aftershock of the pandemic and other things going on around the world.
Yeah, crazy. All right, Hamish, I think that's all we've got to talk about for today.
Yeah. Okay.
Do we have any Q&A questions?
Yeah, I'll ask you one. I'll ask you this first one. Brandon, your course on Profitful was created quite a while ago. So would you think of refreshing it?
It was.
Given that you now know much more about the subject than you used to as well. That's why I'm wondering whether to buy it now or wait for something new.
Without letting too much out of the bag, the answer, will we be refreshing it? Yes, we will be. But that's about all I will say for the time being.
Tell us your
It is a
business
long
plan.
because this is the thing. Okay, this is the thing about these courses. I don't mind if someone wants to make a course because they've learnt about something and they can share that knowledge. I'm all for that. A lot when you get to the personal finance space, investing space, and you look at all these different personalities and they have their courses. A lot of these courses cost a lot of money, and they're also very, very bad.
Yeah.
And the reason they're very bad is because the person behind the course is not thinking about how can I make the best course possible. What they're thinking about is how can I make the most money possible in the shortest amount of time.
Yeah.
So I'm not going to name names or call anybody out, but I've heard when I remember somebody launched their course, and I remember them talking about it. It's like, I've been working on this for the last 3 weeks. I was like, are you kidding? Are you kidding me? You're going to ask someone for like $1,000 and you've worked on this thing for 3 weeks.
Something doesn't add up.
No, exactly. Something doesn't add up. So yes, we are refreshing it. We are not taking the approach of making crappy courses, selling them for thousands of dollars, and trying to maximize our profits and minimize our time spent on them. So for those that don't know, we actually have a post-production team. They're sitting actually behind the camera. So we are going through and refreshing all of the content and producing it very well. We want it to essentially feel like you're watching masterclass, but for investing. And so that is a long process, and it will still be a long way away, but we are doing it. We are going to do it. Just patience. We just need to
Takes time.
We just need to get it done. But take comfort in the fact that we are doing it right. We want to make the best courses on investing on the internet, hands down. No one can even argue with us on that fact.
Yep.
So
yeah, you've definitely got the team for it.
It's coming. Yeah, we've got the team. We're still building out the team. It's just a matter of getting it done. Okay. Do we have another Q&A question, Hamish? I don't know if we've answered this one. I can't remember. Oh gosh, I can't remember if we've answered this one already.
I don't know either. I'm not sure.
I don't know. Do you want to? I think we answered something similar last week, but it wasn't that question. I don't believe.
Let's just do it again anyway.
All right, we're just going to do it again. Sorry if we've already answered it. Hey guys, I've been picking stocks for 2.5 years now and have been following you for about 1.5. Thank you for the great videos. Since starting, I've been studying stock market investing like crazy, reading about the great value investors and their methods, but I'm torn between two methods. Owning a basket of 20 to 30 stocks based on quantitative and qualitative metrics, or owning a semi-concentrated portfolio of 10 stocks based on in-depth analysis. I like reading about companies, but since I have a full-time job and a marriage to maintain, I feel like studying stocks is taking too much of my time. That's totally understandable. I can definitely understand that. I don't want to invest into index funds because picking individual stocks makes me feel more in control. I don't think I have the nerves to own only 10 stocks, but owning 30 stocks makes me feel like I don't fully know what I own.
Yeah.
Hamish, what are your thoughts on this?
I think it's important to say there's quite a lot of differing opinions on how much diversification is necessary in different portfolio structures. There's certainly not a consensus on how to do it, and so I encourage you to read from a variety of different investors, value investors, more traditional institutional investors, and figure out what makes the most sense for you. I can kind of give you an insight, and I will in a second, on kind of what I've learned about this sort of stuff. But there is a lot of varying opinions. Someone like Michael Burry,
# not financial advice.
Of course, not financial advice. But someone like Michael Burry, and the general kind of value investing consensus is that about 10 to 15 stocks a portfolio of 10 to 15 stocks in uncorrelated in different industries tends to be enough to reduce the market risk. Anything beyond that, you're essentially really just adding more risk in terms of the individual picks you're choosing because you're spending less time on them. So that's kind of the general kind of value view on that. But following that, you would kind of say beyond a reasonably diversified portfolio, 10, 15 stocks or something like that, an index fund where you're completely diversified and eliminating the risk of the individual companies would make the most sense. But I certainly appreciate your perspective of wanting to be in control. And for me, that means I have a combination of index funds and individual picks in my portfolio so that I can, concentrate on a few individual stocks and not be too spread thin between 20 or 30 companies. But at the same time, I still benefit from the diversification of participating in the US market or the global economy or something like that. So that's how I kind of think about it.
Well said, Hamish.
But there's certainly a lot of disagreement on that. So I encourage you to seek out other opinions and make your own mind up.
Yeah, and you can even look at the biggest investors in the world, and some of them hold 5 stocks, some of them hold 30 stocks, some of them hold hundreds of stocks. Yep. So this is one of those topics where it just depends on who you're talking to, what they'll say. The only other thing that I'll kind of bolster from what you're saying is that you just got to make sure that you understand every stock that's in your portfolio. So, but you're right, maybe if you can only understand 2 stocks, then you do start asking yourself, well, geez, am I diversified enough? But I tend to gravitate towards what you were saying as well, Hamish. Even if there's only, 2, 3, 4 stocks in my active portfolio, I'm not 100% active. I'm not just an active investor. I've also got, I've got 20 to 30% of my portfolio sitting there passively in index funds. So you can get the best of both worlds in that aspect. You don't necessarily have to be an active investor, full stop. You don't have to be a passive investor, full stop. You can blend those two together, which is what we do.
Yeah.
But yeah, for me, even thinking about 10 stocks, I'm like, geez, am I really keeping track of them as much as I should be?
Yeah.
There's 10 different companies there. So even that number for me is like, oh, geez. I feel like maybe that 10th stock that I believe in, I haven't checked it in a few months. Am I really up to date with everything that's going on? So I don't know.
Yeah.
But again, that's just me, not financial advice. Everybody's going to have a different viewpoint. So hopefully our viewpoints can maybe give you more context as to what you feel like works for you better.
Yeah. All right.
Easy.
Well, thanks everyone for tuning in this week. As always, if you have any questions, feel free to head over to the YouTube version of the podcast and leave us a comment on the latest episode. Or if you're on Spotify, then it's even easier. Just scroll down and you can ask a question right in Spotify. And we will grab as many questions as we can and answer a couple on next week's episode. But thanks, as always, for joining us. And hopefully everyone's having a great rest of your week. And thanks, Brandon, for joining me. And thanks to Sharesight, as always, for sponsoring. But with that said, we'll see you guys next week. So see you later, guys.
See you later.